Welcome to Crypto 101, a first principles jargon-free course on blockchain and its impact on financial services. We are in the process of learning how cryptocurrencies mimic the properties of fiat money. In this lesson, we will learn how payments are authenticated. Specifically, we will learn about the three components of payment authentication, namely anti-money laundering, credential verification and funds sufficiency check. We will then learn how these authentication components are executed for cryptocurrency payments. Before we proceed further with this lesson, let us take a moment to orient ourselves on where we are. We have been learning about how cryptocurrencies mimic the four properties of currency. The property that we are currently focused on is transferability. In the previous lesson, we learned that cryptocurrencies are transferred via the three steps of initiation, authentication, and value transfer. We completed the payment initiation step in the previous lesson. In this lesson, we will learn how crypto payments are authenticated. Before we proceed to the how, it is useful to clarify the what. In other words, what does authentication mean in the world of fiat money? From the perspective of a bank, authentication means three things. These are anti-money laundering, credential verification, and funds sufficiency check. Next, we will learn what these are. The bank has a regulatory obligation to ensure that a payment is not supporting illegal activity. These are called anti-money laundering or AML regulations. Credential verification refers to checking whether the payer is the authorized owner of the account from which payment is being made. The source account may be a bank account or a credit line like a credit card. Funds sufficiency check is the process of verifying that the payer has the funds to support the payment, either in a bank account or through an approved credit line. Before we proceed on a deeper dive on authentication, it is helpful to take a step back and reflect on the relationship between initiation and authentication. The output of the initiation process is a pending payment transaction. We can think of the output of the initiation process as an input of authentication. The output of the authentication process is a verified transaction. Next, we can review some examples from the world of fiat money. I initiate a payment by writing a check. The output of the initiation process is a signed check. This signed check is an input for the check authentication process executed by the check writer's bank. Another example is paying in store with a credit card. The payment is initiated with a swipe, tap, or insert into a card reader. The output of the initiation step is a payment message containing both payment details and card details. This, in turn, is an input to the approval system of the credit card issuing bank. Now let us apply this framework to crypto payments. In our earlier example, we initiated the payment from a wallet. The output of the initiation step is a payment message with an attached digital signature. This is an input to the authentication step. This input is validated by a bookkeeper on the blockchain network. In this lesson and next, we will learn how each of the three components of authentication occur in the world of fiat money and crypto money. We will cover fiat money first. Money laundering is the disguise of funds received from illegal activity, in a form that makes it appear that it is being received from legitimate sources. The goal of regulation is to prevent money laundering and terrorist financing. A major problem criminals face is that they are forced to accept payments in cash, and it is difficult to store large amounts of cash safely. Next, we will review a scenario where a bank can become a vehicle for money laundering unintentionally. Tom runs a food truck. The nature of the business is such that many customers pay cash. However, Tom's primary source of revenue is dealing illicit drugs. Tom receives payments for his drug sales in cash. Tom deposits cash in his bank account every week. The bank thinks that this is cash generated from his food truck business. Once the funds are deposited into the bank, from that point, they can said to have been laundered into something that looks clean. Anti-money laundering regulations typically center around two broad areas. One is customer due diligence. Banks are required to make reasonable determinations on whether the individuals and businesses they are working with are not engaged in illegal activity. Second, they are not only expected to weed out suspicious customers but also flag any suspicious transactions. Let's dig into each one. Customer due diligence, at the most basic level, means that your customers are who they say are. This is called Know Your Customer or KYC. For individuals, it means verifying their identity and address records against documents like driver's licenses and passports. For companies, it means verifying the formation documents of the entity and its nature of business, as well as verifying the identity of the entity's beneficial owners and key executives. Banks are also required to screen customers against lists of individuals and entities that are sanctioned by the government. A well-known list is the OFAC list. This is a list of sanctioned individuals, entities and foreign governments maintained by the Office of Foreign Assets Control, a department within the U.S. government's Department of Treasury. Despite customer due diligence, there is no guarantee that a customer won't engage in criminal activity. Hence, banks are required to monitor suspicious activity and inform the concerned regulatory authorities. In our previous example, if Tom usually deposited $2,000 per week but suddenly came to the bank wanting to deposit $50,000 in cash, any bank would treat this as a suspicious activity. Next, we will move on to the other components of payment authentication, namely credential verification and funds sufficiency. In the fiat money world, credential verification occurs in three ways: possession, knowledge, and adherence. I will explain each with an example. Possession means that physical possession of a payment instrument is sufficient for the transaction to be approved by the paying bank. Consider what happens when we use a credit card in a store. It takes a few seconds for the transaction approved notification to appear on the point of sale. During those few seconds, a message seeking approval is sent to the paying bank, in this case, the credit card issuing bank. In the United States, at most merchants, the mere fact that the payer physically possesses the credit card is sufficient. Merchants rarely do signature comparison or ask for an identification. Knowledge here refers to the knowledge of something that only the authorized account holder is expected to know. When we use a debit card in store, we are usually prompted to enter a PIN. It takes a few seconds for the transaction approved notification to appear on the point of sale. During those few seconds, a message seeking approval is sent to the paying bank. The paying bank verifies whether the PIN was correct. This is an example of two-factor authentication. One factor is the physical possession of the debit card and the second factor is the knowledge of PIN. Adherence means verifying an attribute that is an inherent characteristic of the account holder. An example is a wet signature on a check. Some may argue that this is not an inherent characteristic as it can be easily forged. A better example might be when used Touch ID or facial recognition to log into a fintech app. When the paying bank receives our instruction to pay, it just assumes that the payer is the authorized account holder since she was logged into the app. In fiat money, we pay from balances and not from UTXOs. A central party in the form of a bank makes the determination on whether the payer has sufficient balance. In fiat money, depending on the mode of payment, there can be a significant time lag between the initiation of a payment and receipt of the payment by the beneficiary. Hence, giving credit to a beneficiary before the bank actually receives funds is a point of negotiation between banks and their business customers. An example is a bank that credits a check deposit before being paid by the paying bank. Another example is an overdraft facility. We will now summarize the discussion of authentication in fiat money. It is a bank's responsibility to check for three things on every payment. First, the payment is not meant to facilitate illegal activity. Second, the payment is being initiated by an authorized account signatory. Third, the payer either has sufficient funds or adequate unused credit limit. Now that we have covered the three components of authentication in fiat money, we will learn how authentication occurs in crypto money. Just as in fiat money, a crypto transaction may represent a payment for an illegal activity. Hence, the underlying need for AML exists in crypto. However, the extent to which illegal activity can be prevented or detected largely depends on the method by which the crypto payment is made. Next, I will expand on this concept further. Since their inception, cryptocurrencies have become popular because people can easily exchange between cryptocurrencies and fiat currency. Assume Alice has 0 bitcoins in her blockchain address and $20,000 in her bank account. Alice wants to buy Bitcoin. Bob has 1 bitcoin in his Bitcoin address and $0 in the bank. Bob wants to sell his Bitcoin. A crypto exchange, just like a stock exchange, matches Alice and Bob. Cryptocurrency is transferred from Bob's Bitcoin address to Alice's Bitcoin address. Fiat money is transferred from Alice's bank account to Bob. Crypto payments are, thus, of two types. In the first category are exchanges between fiat money and cryptocurrency. The other are pure crypto transfers between account holders. Next, we will dig into each one. In the example that we just saw, the crypto exchange maintains a bank account. It receives fiat money from Alice into its bank account and then transfers that to Bob. The exchange transfers cryptocurrency from Bob's blockchain address to Alice's. The exchange is maintaining non-custodial wallets for Bob and Alice. Since the exchange is interfacing with the banking system, it is easier to impose AML regulations on it. If the exchange was found to be facilitating illegal transactions between Bob and Alice, the regulators will cut off its access to banks and its whole business model will collapse. Let us continue with the story further. Alice, now, has cryptocurrency in the Bitcoin address. The private key of this address is held in a custodial wallet operated by the exchange. Alice now transfers the currency to her non-custodial wallet. From this point she can transfer the Bitcoin to anyone she wants without the exchange knowing about it. If we think of pure crypto payments, effectively data is being transferred between accounts, represented by blockchain addresses. Hence, regulators can do little to stop people from doing this if they have self-custody of the private keys, the same way they cannot stop a group of friends trading monopoly money between them. Crypto assets can transfer from one address to another anonymously till the point somebody needs to exchange the Bitcoin with fiat money. However, the journey to that point may be so circuitous that it could be impossible to determine the provenance of the transaction. All this does not necessarily mean that pure crypto payments are anonymous. Let us flip back to the continuum of decentralization that we reviewed in the previous lesson. To the extent someone is running a node on the extreme left, it is difficult to track who is paying and to whom. But as we move towards the right, the degree to which AML checks can be enforced is dependent on the policies of the intermediary and the regulatory regime under which the intermediary is working. We can recap the takeaways on AML and crypto payments. First, AML regulations are not specific cryptocurrency payments. They are determined by legislation and regulation. Second, the degree to which AML regulations are applied on crypto payments rely on the degree of reliance on intermediaries and the extent to which the intermediaries comply with these regulations. Custodial wallet software providers and exchanges are examples of intermediaries within the crypto ecosystem. We can now move on to the other two components of authentication in cryptocurrencies: credential verification and funds sufficiency check. Credential verification in crypto payment occurs via validation of digital signatures, which are generated from the private keys of the account holder. The topic of digital signatures has been covered in prior lessons. Hence, we will not repeat the discussion here. In a previous lesson, we learned about the concept of unspent transaction outputs or UTXOs. These are the portions of incoming payments that are unspent. Payments are made from UTXOs. Every transaction on the blockchain has a unique reference number. If we created a transaction where the intended payments were greater than the referenced UTXOs, the transaction would be rejected by the blockchain. So far in this lesson we have covered what is being authenticated. These include the legality of the transaction, the authority of the account holder and sufficiency of funds. Next, we will learn the mechanics of transaction authentication. As we discussed previously, to the extent AML checks are done, they are done by intermediaries like custodial wallet providers. Their processes are not different from traditional banking. Hence, we will focus on the mechanics of credential verification and funds sufficiency. Before proceeding further, let us take a minute to recap what the blockchain network is. It is a network of interconnected computers that stores data in a duplicative manner. Anyone can join a permissionless blockchain by downloading software onto their computer and establishing connection with other nodes. Each computer is directly connected to a few other nodes. Information flows from one computer to the other in a cascading manner. Each computer on the network is called a node. To become a node, a software needs to be installed on the computer. At the time of joining the network, the node must download the entire history of transactions on the blockchain. This ensures that each new joinee has the same records as legacy nodes. For Bitcoin, the most popular version of software installed on nodes is called Bitcoin Core. Bitcoin Core software code is publicly available on GitHub. While the code itself is available for everyone to see, only super users have the ability to edit it. Now that we have recapped our understanding of the blockchain network, we can proceed to learn how transaction authentication occurs. In a previous lesson, we saw how wallet software can be used to initiate a payment transaction. The payment transaction is first routed to the node of the wallet company. The first node runs the validation software, which checks among other things the validity of the digital signature and sufficiency of the UTXOs referenced. After it validates the transactions, it is propagated to other nodes that are directly connected to it. These nodes in turn validate the transaction and send the transaction to other nodes. The first node to which the transaction is directed may be run by the wallet company or a third-party node provider used by the wallet company. Each time a node verifies a transaction, a success message is sent to the originator of the payment. This process by which the transaction is exponentially spread to other nodes is called flooding. Verified transactions are those that have successfully passed transactional authentication by a majority of the nodes on the blockchain network. We are currently in the process of learning how cryptocurrencies mimic the property of transferability of fiat money. We have learnt that this occurs through 3 steps. In this lesson, we completed a discussion of authentication, the second of the 3 steps. In the next lesson, we will cover transfer of value. But before that, review the summing up section of this lesson.